listed here in Australia. We are an ASX-listed gold company that has all of our activities focused on the African continent, where we currently operate 3 mines, and we have a couple of development properties that will be put into development in the very near future. We are travelling quite well under the circumstances, and we've released our June quarter and full year result for the financial 24 year today, and happy to share this information with you.
Jeff, good to see you again. It feels like last week since we spoke, because it was. Let's talk about the numbers first. Q4 and 24 year end. What do they look like?
Well, look, they're reasonably solid actually. Another good quarter, another good half year, another good financial year for us. So in the June quarter itself, we produced 120,929 ounces of gold at an all-in site cost of $1,173 an ounce, giving rise to a margin of $944 US an ounce, delivering $117 million US dollars of notional cash flow, which has left the company in a fairly strong position of having $587 million US dollars on the balance sheet, cash and bullion. Now, if we look at it on the full year perspective, so this is fiscal 24 ending in 30th of June this year, we've produced 509,977 ounces of gold during the year at an all-in site cost of $1,053 an ounce, generating a margin of around $961 an ounce, or a notional cash flow of $490 million US dollars. So it has been a very good year for us. It has meant that Perseus is very firmly on track to continue to fund its growth, and also to continue to return capital to shareholders.
Okay, so some good steady growth from you. In fact, we're looking from 2020 to today, up over 3 times. So that's good, steady, accretive growth. It says to me you have designed and built a specific type of business, and that will attract a specific type of institutional investor. What are the things that you focus on? Because I'm looking, obviously, huge kind of cash position, cash, bullion, equities, zero debt, and the sort of debt facility there. So the bottom line, which most people would kind of hone in on, is important. But what else is important to you?
Well, look, there's a lot of things that are important, but at the bottom of all this is we're seeking to generate cash. I mean, we make as many ounces as we can at the lowest possible cost. And in fact, over the last 3 years, as you said, we've averaged something like 513,000 ounces of gold a year for the last 3 years. So this year's result is no fluke, as it were. This is part of what we've been doing for some time. But very importantly, what we have been doing is keeping our costs under control, which has allowed us to, in a rising gold price environment, to increase our margin, which means increase our cash flow, which gives us the wherewithal, as I said earlier, to not only fund future growth of the company and to enhance the ability of the company to survive into the future, but it's also given us the ability to return cash to our shareholders.
Okay, I want to look at some of the moving parts, because I'm trying to sort of work out where you kind of sit in the mix, as it were, because there are, there's a few producers to choose from, and I'm trying to want to get a sense of, does your business suit my risk appetite? So let's start with growth, because that's what it's all about. M&A, you've made a couple of acquisitions. You're obviously focusing in on the best possible acquisitions, the best possible price. Can you talk about your sort of attitude to what you look for when you do M&A?
Well, yes, there's a number of things. I mean, obviously, the risk-return ratio is terribly important, in the sense of, making sure that there is adequate prize available to us to reward us for the risk that we assume through the acquisition. Now, our clear preference is to acquire assets that are in the pre-development stage, and to use our in-house engineering skills to take projects through the development pipeline and put them into operations. We believe that by doing that, we can create the most value for our shareholders. So that's our sweet spot per se. The other piece of the acquisition business that has been important is that we believe that Africa does have its challenges, and the best way that we can serve our shareholders is to present a balanced portfolio, one where we have multiple mines, multiple jurisdictions, which allow us to take, or enable us, I should say, enable us to take the volatility out of our earnings, so that, for instance, in one particular year, one operation may not be going so well, but the others are going well, and they compensate. So as a group, we do well. Or I guess to the point of some commentators who are concerned about geopolitical risk, one country may be going through a difficult period, but the others are going well, in which case, once again, the properties and countries that are doing well compensate for one that perhaps isn't. So it is about finding the sweet spot where value can be created, and it's about doing it in a way which minimises the risk for us as a business, and for our shareholders as a result.
Okay, and look, I want to come back to the risk thing, because you mentioned that word a few times there, and I'll come back to it in terms of the defense strategies that good companies need to employ. Just sticking with the growth component for now. Obviously, the acquisitions have delivered scale, which is attractive to large institutions. For sure, but it's also about sort of driving share price. That's how we all make money. So in terms of the things on the growth side of the story, again, focusing on what you think is important to the market, is it pure M&A, or is it capital allocation? I mean, what do you hone in on?
Well, look, I think we have been told, and I believe this to be true, that what the market wants is this. They want to see asset quality. So in other words, long life, large deposits. They want to see growth, so they want to know that you are actually delivering more on a compounding basis. They want to see cash flow, and they want to see high quality management. Now, I believe that Perseus delivers all of those things. Perhaps a criticism can be put at us to say, well, the quality of your assets is not, they're not top tier assets, and that's true. We don't have the same sorts of projects that, say, for instance, a Newmont or a Barrick, have in their portfolio. We have the assets that we have, but what we are doing is progressively upgrading the quality of that portfolio by bringing in projects like the Nyanzaga project that has a 15-year mine life ahead of it, or the Bayer Sand project in Sudan that, once developed, has another 15 years ahead of it, both of which have the opportunity for significant expansion through exploration. So in that sense, those sorts of assets, by bringing them into the picture, as we did with Yaouré, I might add, back in 2016 when we took over Amara Mining, we added that to the portfolio and added a project that, 16, 17, 18 years of mine life, it's a high quality asset. So that's what, the M&A piece does deliver. It delivers scale, it delivers quality, it delivers cash flow, it delivers growth. And of course, to do all that, you need to be able to demonstrate reasonable standards of management.
Right, and again, sticking on this side of the discussion, recently we sort of engaged with some companies with the sale of a copper business in Chile. Lots of people pitching up, and a few people saying, "Well, we built 2, 3, 4 billion-dollar plus companies," and I sort of looking at the share chart there. And it's sideways. All of those businesses, the share price was sideways over 5-year periods. No growth on the share price, and that's ultimately how I make money. So for you, you have achieved that since 2020 through to now. Like I say, plus 3 times your money. What do you think you've been valued on? And what do you think you'll be valued on moving forward? I know you've said some of those things, but just that must be a topic of, conversation at board level on a regular basis. So if you can kind of look back and then look forward for me.
Well, look, one of the things that we have really worked very hard at over time is delivering on our promises. So we do what we say we're going to do. And we do that on the basis that an investor looking at Perseus knows what they're going to get. If we say we're going to, this is our guidance, this is what we're going to do, then that's what we do. If we say we have a dividend policy which will yield a minimum of 1% per annum, plus bonuses if additional cash is available, then that's what we do. So I think what we're seeking to do is to become known as a very, very reliable company that generates solid returns on funds employed and rewards shareholders for their participation in the company through regular returns of capital.
Okay, let's flip over to the other side in terms of the defense, because I think it's great when the markets are working for you, when gold price is on a run. I think, but we're both old enough to sort of remember when that wasn't always the case. Unexpected moments, and that's in terms of gold price, in terms of capital markets, in terms of as you said earlier, sometimes projects don't deliver, what you expect, and you've got to mitigate for those things. So in terms of the operation, you've got a lot of cash, gives you a lot of optionality. Again, what are the things you focus on in terms of the downside risk mitigation?
Well, look, we're in a very buoyant gold price environment right now, and we're all enjoying it enormously. But I have to say, I know it's surprising looking at the colour of my hair. I'm not, actually a very young man, but going back in time, I mean, we have seen some pretty dark days. And, while we don't expect to revisit that in the near future, it is distinctly possible that the cycles of commodities could bring the price down. Now, we as a company need to insulate ourselves against that occurring, because there is a chance that it will occur. Now, what we do to do that, for instance, is that we, from a pricing point of view, we do price hedging. Now, I know that that's not popular with some folk, but we believe that it makes good common sense to manage the biggest risk that a gold company faces, namely gold price risk. And we do that in a methodical way that doesn't involve expanding the risk of the company by using exotic derivatives that none of us understand. We do it in a very simplistic, very mechanical kind of way, where we deliver into the low price hedges, and if the opportunity arises, we sell it at a higher price, and we gradually edge up the value of the book. So that's the way we've been managing price.
How many ounces do you hedge?
Well, our policy would allow us to hedge 30% of our projected production over a 3-year period. We actually are about 24% at the present time, and we have a weighted average price of that book of $2,200 an ounce. Now, it wasn't so long ago when the idea of selling gold for $2,200 an ounce was a pipe dream. But you can sort of see that in the event that the prices do pull back, we are going to be able to sell 30 or 24% of our production at that elevated price. The balance will be sold lower, but we will still have sufficient cash flow to meet all of our obligations as and when they fall due. And particularly given, as part of our growth strategy, we do have some significant capital expenditure coming forward in the next couple of years. So the Nyanzaga project, for instance, in Tanzania, will require investment somewhere in the range of $450 to $500 million. Now, the last thing in the world we want to do is to get halfway through that build, discover that the gold price has fallen back, and then find ourselves in urgent need injection of either equity or debt capital. Because if we find ourselves in that position, we're going to pay through the eyeballs. That's assuming that we can actually even get it. So what we're trying to do is to make sure that this is a sustainable, resilient business under all operating conditions, and one that can continue to generate benefits for all of our stakeholders, bearing in mind that apart from shareholders, the benefits that all of our other stakeholders derive are cash-based. So we pay salaries to our employees in cash. We pay taxes to the government in cash. We pay benefits to our host communities in cash. Shareholders get certainly dividends, but they also get capital gains or losses, as the case may be, in the event of share price movements. So generating cash, coming back to our original point of discussion, is critical to Perseus. We have to do everything in our power to maximise that aspect of the business.
Right. So that's the planned component of the cash allocation in terms of the operational growth, etc. In terms of the kind of rainy day fund element, again, how much do you allow there? Because people say, oh, you should be dishing out bigger dividends, or you should be more cash buybacks, or you should be whatever they think you should be doing, telling you how to run the company. Is you must have that kind of rainy day mentality of not just when gold price goes off, but maybe when things go wrong on the ground.
Well, we do. I mean, internally, we manage our balance sheet to say, well, we want to retain a certain amount of liquidity on the balance sheet, et cetera, et cetera. I mean, we don't, go into the ins and outs of all that in public, but certainly we do look at the situation, and it is dynamic. I mean, we look at our position on a regular basis and say, well, this is what we have on the balance sheet today. This is what we expect our needs to be in the short and the medium term. This is how much we're going to generate in the next 6 months or 12 months. This is what's surplus at the end of it. And that's the money that we say, well, look, we can very readily return that to shareholders without jeopardizing either the ongoing cash flow of the business or indeed compromising the integrity of the balance sheet or preventing us from continuing on a growth path.
It's kind of interesting. I think some CEOs run their balance sheet and their cash positions like some teenagers run credit cards. Do you know what I mean? In terms of that high risk, high leverage, play expecting things to actually, come off every single time, be able to kind of, pay back the credit card at the end of the month. And sometimes they can't. I think it's, therefore, I as an investor need to say, well, is that the type of CEO? Is that the type of company that suits me? Quite frankly, I don't need that headache. Is my attitude to these things.
To be fair, I mean, that is a valid strategy. It is a high risk strategy, I might say. It probably generates superior returns to a more conservative approach. It's all about how you perceive risk, et cetera. But just I don't think it's right to say people shouldn't do that, but they need to be aware of what the potential downsides are. And similarly for investors, by all means, invest in a high risk strategy, demand high returns, but don't cry if you lose your money.
Well, I think that is the issue. It's great when the sun's out, but when it rains, you've got very few options if there's no umbrella on site.
well, indeed. And we would like to think that we present a case to the investment community where people know what they're going to get. They know they're going to get a good, reliable return over a long period of time. It may not be the most exciting show in town, but it's certainly going to deliver the outcomes that we promised in the first place.
Jeff, appreciate your call. Thank you very much.
Thank you. Thank you for having me.